All right, welcome back to another edition of Advanced Accounting. We're going to continue on with Chapter 2, and there's only a few examples in this lecture that we really need to go over with regard to mergers and acquisitions. But let's start off by talking about what is a merger and acquisition. Essentially, what we're talking about is control. So we're beyond just plain old significant influence, and now we're actually owning a subsidiary or a smaller company. And there's different types. We've got mergers, we've got consolidations, we've got asset acquisitions. Generally speaking, the ones that we're going to focus on the most have to deal with mergers where we kill off the subsidiary and say thank you, onboard all of their net assets. Consolidation, that is not really what we're going to be looking at. Consolidation is one where essentially we create a brand new company called Time Warner from Time and Warner. So that is not necessarily a key feature here. So we'll talk about mergers, and we like mergers because they tend to be the easiest for accounting. Then we'll also look at stock acquisitions that really involve the equity method of accounting, which is a pain in the neck. Down below, you see some information about why companies engage in consolidations and acquisitions. I think it's pretty intuitive and straightforward. Generally speaking, the only reason why you really see mergers and acquisitions today is because there are profits available in doing it. So here, let's look at an example where Beerbo pays $10 million to acquire DMC, and we're going to treat the sucker as a merger. And what we do is we focus on just the fair value of the individual assets and liabilities on the target's books. So our target, the smaller company, the investee, they're going to have long-term debt, current liabilities that we will take responsibility for. And keep this in mind too. It's possible that we have, when we look at the long-term debt, that maybe it's traded on an active exchange, like a bond exchange. The fair value of a long-term debt could be higher or lower, relative to the book value. That's something we'll have to take into consideration in addition to getting the fair values of the individual assets. Now, someone asked me, why don't we just bring on board their book values? Why do we have to worry about the fair values? And the idea behind this is we're the ones who are buying the company. Just as you would go to the store, grocery store, or go to Starbucks to buy coffee, you're going to pay the fair market value of whatever those goods are. You're not paying the cost basis of the coffee or the Cheetos or the beer or whatever. You're going to pay the market price whenever you go to a store. We're doing the same thing here. We're looking at the fair value or the market price of the company, but we're doing it on an item by item by item basis. So down below, the simple way of doing a merger is to take all the information from their balance sheet, add or subtract any fair market value adjustments, and then bring on board the fair values of all the individual items. So current assets, equipment, patents, liabilities, long-term debt, these are all fair values, not the subsidiary's book value. We don't care about that. And then there's our overall cash that we paid. This is a pretty simple example because in this situation, what we pay in cash equals the fair value of these individual net assets. So there's no goodwill involved in this case. There are some situations where we do pay more. Usually that's in the form of goodwill. There are very few situations where we pay less than the net book value, the fair value of the net assets. In those situations, we call those a gain on bargain purchase. We'll look at that later on. So mergers. In the case of a merger, what just happened? Well, the target investee, the subsidiary, ceases to exist, right? Oh, that's sad. They're dead. But we like that because it makes the accounting way simpler for us. When the target's investees' assets and liabilities are brought on board, we bring on board their assets at fair value, their assets and their liabilities. Their equity is gone. Essentially, we're going to ignore that stuff. We're just looking at the net assets that we're bringing on board. The equity is essentially stockholders' equity. Once the stockholders are paid off, they're gone. All we care about, all that's left over are the net assets. Consolidation, I think we talked about that earlier, absorbs both the investor and the investee. We don't need to look at that too much. Stock acquisition, the accounting for this sucks so much. Because why? Because we use the equity method of accounting, and there's so much accounting and so many worksheets we have to fill out, and that's the joy for the next chapter. So I'll also sort of stop it right there, and we'll kind of move on with that. So in the case of a stock acquisition, okay, keep this in mind. It's sort of deceiving. A stock acquisition, I want you to think equity method of accounting. Okay, and I want you to think, oh, that's boring. That's tough. It's a lot of work we have to do, but we get paid the big bucks. It's fine. This journal entry here, excuse me, is much, much simpler. We don't have to take the individual fair values and or onload them. We just net all these together into one amount and stick it as investment in Dudmeiser Company. It's an investment account. There's the cash. But again, don't be deceived by this. It looks simple, but the accounting will be painful later because we have to constantly update this account for earnings, dividends, amortization, all those things. It's kind of ugly. Let me skip down here. When we're looking at a merger or a stock acquisition, we do have to consider whether or not there's goodwill. Usually today, whenever a company buys another company, there's always some form of goodwill. The acquisition cost, right, the price paid is usually much greater than the fair value of the net assets, right? So remember, there are book values on the target's balance sheet. Then there are certain adjustments, fair value adjustments that go up higher, right? And then there are other things we consider that are not on the balance sheet, any type of fair value bumps associated with maybe technology or some sort of core competency. And then on top of that, you got goodwill. And that's ultimately what's going to give us the purchase price of the company overall. Is there a situation where it goes the opposite, where we pay less than the overall fair value? Yes, it does happen. But those are situations where the company, the target, is in a distressed situation. We're taking advantage of that. We're kind of bailing them out in a lot of ways, though, too. So, how do we estimate? Some of you have talked to me about, or at least some of you have, but I've always get questions about, hey, how do you measure fair value of certain assets? Well, go talk to people who do that. So Nick Mears is the principal owner of Caprock Consulting here in town, and one of the things he does is he values businesses. And so he'll tell you, hey, when I go look at a company's accounts receivable, I'm going to calculate a discounted future cash flows. He's going to look and determine, hey, how much of this $1 million in receivables is actually collectible. Now, here's the tricky part about this. You don't need to worry about about measuring the fair value of these individual assets. I give you that information. But what you do need to be careful about is going beyond this. You see, all these different accounts, inventory, PP&E, liabilities, these are items that we see on the balance sheet. But you have to be careful because there are certain intangible assets that we do not see and that we have to take into consideration. One of those things could be intellectual property or some type of core competency, right? Maybe there is some sort of unpatented technology that needs to be valued in the purchase price, okay? I give you that information. You just need to be aware of it, look out for it, and incorporate that in your calculations. Now, the one thing we have to be careful about when it comes to these invisible or intangible assets, we can't just make shit up. There's going to be some things that are legitimately valuable and some things where we simply say, yeah, that's a good thing the company is doing, but there's no way we can put a price tag on that. What we're concerned about here is saying beyond what's on the balance sheet and the markup to fair value, what are some unreported intangible assets here? So under GAAP, identifying previously unreported intangible assets, there is a process. Okay, I don't want to go over this in too much detail, but essentially what the FASB is saying is there's ways of categorizing or looking at a company from different perspectives. Okay, we can look at a company from a contract-based perspective, try to figure out, does the company have some sort of special broadcasting rights that maybe doesn't appear on the balance sheet as a value? Maybe there's certain construction permits, right? Leases, franchises, etc. Looking at the company from a market related perspective, brand names tend to be a big one. That sticks out pretty well. Brand names, trademarks, etc., that's marketing related. Sometimes you can see it in other areas too, but brand names is a big one. Non-compete clauses, customer related. Let's look at a company from its customers. What sort of customer lists or contracts does the company have that enable them to generate future cash flows? Let's look at the company from its technology. Does it have some sort of patent on producing a drug? Does it have some sort of developed specialized technology? Maybe there's some research and development in process that looks pretty feasible. Let's look at the company from an artistic basis. Sometimes people consider brand names as part of the artistic base, but just keep in mind that regardless of whether or not you classify these into one bucket or another, realize that looking at this, whether or not these different bullet points belong in these certain categories doesn't really matter. The idea is these 5 buckets are a way of perceiving a corporation and determining, hey, you know what? We never really considered, does the company have some sort of recordings available that are valuable? Maybe there's some sort of B-side tracks from Johnny Cash way back in the day that need to be dusted off and produced out there. We don't really know. But this is just an overall list of things we need to consider looking at a company so we can identify some of these intangible assets. But be careful. Don't get carried away by this. There are certain things that do not meet the criteria of previously unreported identifiable intangibles. And usually some people tend to look at a workforce. Hey, we got a really strong workforce, a lot of seniority. We got people who've been working here 20, 30 years. They know the shop like the back of their hand. That's great. I hope they stick around after we buy the company. But that's not necessarily what I would say is an intangible asset, because you can't really put a price tag on an assembled workforce. If you were to do that, generally speaking, that would be valued in the form of a pension. But that's something beyond the scope of this class. So assembled workforce, hey, great that we got seniority. I don't really care. Potential revenues, potential cost savings. Yeah, maybe when we look ahead at some maybe contracts under negotiation, maybe we look at certain markets that we haven't fully explored, there's a lot of potential in there. But we cannot look at those and say, oh, those are intangible assets as well. If they haven't been put down on paper somehow, then we cannot consider them an intangible asset that we would value when we're purchasing a company. So this is where we would see the seller, the target, the subsidiary coming to us and saying, hey, you know what, we got this awesome workforce. And we as the purchaser would have to diplomatically say, thanks, that doesn't matter. And I mean that diplomatically, especially. Goodwill is the final part, the other hidden intangible asset. Goodwill, we look at that. It's pretty much a plug figure when we look at these examples down below. Calculating goodwill is not hard to do. There's different ways that the book shows you how to do it. You can pretty much just plug it into a journal entry and call it good. Beerbo pays $100 million in cash to acquire Miller Lite. The fair value of the individual assets and liabilities are below. So yes, we could go through and do some sort of analysis here and say, let's look at the overall cash paid and break it down between the fair value of the assets and the fair value of the liabilities, and then figure out what is the plug figure that we need to get ourselves to the 100 million. So this is the fair value of the net assets down below here. And here's the cash paid. What's the plug figure? It must be goodwill. That's a lot of goodwill relative to the fair value of the net assets. Maybe we really, 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 really wanted this corporation. That's one way that some of your homework will ask you to fill in the analysis. I prefer to say plug it in the journal entry. If we have to onboard all of these assets and liabilities into a journal entry, then let's start doing it. Here's your assets. Here's your liabilities. You know what the cash is. Boom. The plug figure is goodwill. That's all you really need to do. And from my standpoint, that's simpler to do the analysis that way. But you decide on what you want to do. When we consider the same type of example, and I forgot to change this. Again, assume this is Beerbo, not Duke Energy, Badger Electric, Miller Lite. Right? Same situation, but we're gonna also incorporate some type of intangible assets that haven't been reported. And so let's say that the company that we're buying, Miller Lite, comes back and says, hey, we've got all this stuff. You should pay for all these extra things. And we would want to say, hold your horses. Let's go through these one at a time. Brand names. Is that something I would consider an unreported intangible asset? Yes, I'll pay for that. Favorable lease agreements? Sure, I will pay for that as well. Assembled workforce? No, I'm not going to deal with that. Potential future contracts? No. If they're not in writing, I don't really care. Some sort of developed technology? Yeah, sure, okay, I'll record that. So again, this is part of the negotiation. When we're dealing with the board of directors, we want to be very careful about what we're willing to consider some type of intangible asset, because if we bring this stuff into our balance sheet, we have to later justify these values to our auditors. It makes more sense to say right now, let's hold off from classifying something as a questionable asset. Because if for whatever reason, let's just say, we brought on a debit for an assembled workforce, and what was that? The 60 million, and we say we credit, that's part of the credit to cash when we bought the company. If our auditors come back and they say, you know what, there is no such future economic benefit associated with that, you need to take it off your books. Guess what we would need to do? We would have to debit some type of merger expense for $60 million and credit away that previous debit to the assembled workforce. So we don't want to be too careless with this. On the other hand, if I simply say, hey, you know what, you got a great assembled workforce, but I'm not going to pay for that, or I'm not going to consider that part of the price. Essentially, I can still allow myself to pay an extra amount of cash. Let's say I pay an extra $60 million in the original purchase price. I wouldn't, but if I say I'm doing that out of goodwill, rather than some sort of beaten, nonsensical workforce thing, I kind of preserve this asset. I don't have to worry about writing it off right away. So we have to be very careful about which intangible assets that we choose to bring on board for the risk of having to maybe later write them off as an expense. So down below, same type of information, but now we have these other three different previously unidentified intangible assets. So when we look at this, we can see, okay, there's an additional $10,500,000 in intangible assets. Okay, so we stick these in. So these are new. These are new line items in our journal entry. And what does that end up doing to the rest of the journal entry? Well, everything else is the same, except for, guess what? Goodwill. Goodwill has gone down by $10.5 million because essentially before, when it was like $90 million, or the 90, excuse me, the 90, the $94 million, that was okay, but now we sort of reallocated some of that goodwill to other previously unidentified intangible assets. Let's take a quick look back at the previous example up above. There's goodwill, the $94 million. What are we doing in the next example? We're saying, hey, some of that could be other intangible assets. So down below, we said, okay, let's reverse out out of the $94 million that wasn't goodwill, we're going to allocate some of it to specific intangible assets, but we're doing it very carefully. Again, if we find out later that any one of these the auditors don't like, we have to essentially expense them. So if something bad happens, auditors doesn't like the brand name, we would have to debit a merger expense for $2 million and credit away the brand names for that $2 million. We don't want to do that. We want to be very careful about creating new asset categories as a result of this merger. So this is all the accounting that we have to do when it comes to doing a merger. Once this stuff is onboarded to our books, we get rid of or we dissolve the subsidiary. So they're gone now. Contingent considerations, I'm going to skip ahead from that. I'll let you read that on your own. The only thing I would really say about contingent considerations has to deal with if there's a situation where we promise to reward the existing employees with a bonus if they continue working really hard and meet certain earnings targets. If we promise to do that, we essentially have to create a liability, a contingent liability for some potential future earnings targets. A lot of companies do this. There's some bad blood, don't get me wrong. There's some employees from the small target company who won't want to be merged. And so we have to be very sensitive to those feelings. We have to incentivize them to keep working hard. How do we do that? Hey, stick with us for a year, work your butt off, meet these earning targets, and we'll give you a bonus. Sometimes that's part of the deal as well. Acquisition related costs. Now, this is where you have to be more broad, think more broadly about these types of acquisitions. There are other ways to acquire a company than simply paying cash. A lot of companies will, to save cash, will instead of crediting cash, they'll credit new issuance of their common stock. And that's a way of saying, hey, look, our stock is currently trading at $30 a share. Let's issue some new stock. The stock price will probably go down because of excess supply, but there's still some value in our stock according to the market. So let's give these shareholders less cash and just swap out their stock for some of our stock. Sometimes you hear that phrase stock swap. If we do decide to do partial stock swap in our acquisition, we have to worry that there's going to be a lot of outside expenses, especially when it comes to issuing new stock. In particular, securities registrations. That is not cheap. And if we have to go through lawyers and we have to go through regulators, the price tag just keeps mounting and getting bigger and bigger and bigger. So let's again look at a Beerbo example where we say Beerbo pays the following to acquire coronavirus CBI. Cash paid to former owners of CBI. Great, we gave them $50 million. We also issued new 1 million shares of stock, and the new shares currently have a fair market value of $60 million. So that's essentially saying that if we look on the stock market, our stock is trading at $60 a share. Let's issue 1 million new shares. I mean, that's just printing paper, folks. Well, yeah, but you also have to pay a cost when you actually register that stock. So there's a cost associated with doing it. It's sort of kind of a wash at the end of the day. Cash paid for merger advisory services and any type of expected payout agreement. Okay, let's just take a quick look here at this when we think about issuing stock. If we agree to give out stock, yes, we're essentially printing off $60 million worth of stock certificates. But the net effect, when you sort of look at this from our perspective, is it's really something going to give us something more like 59 million because we have to pay people to do this stuff. So keep that in mind as we go down below. Issuing stock is not cheap. There's always a cost associated with that. We're going to keep some of these other facts that we saw before. There's an analysis. If you think that's useful, I say go for it. Down below, I say, why not just pop the sucker into a journal entry? So here we go by the same thing as we've done before. We bring on board all the identifiable assets and the identifiable intangible assets. The cash is 53 million down below. And then we've got that earnings liability payout. Hey, stick with us and we'll pay you $1 million if you meet earnings targets. Some new information on this journal entry is as follows. You've got the merger expenses, the $2 million from up above. That's essentially paid out in cash. There's another $1 million that we paid in the form of stock registration certificates. But you don't see, there is no stock registration expense. Because the FASB says you don't expense stock registration fees. Instead, you net them down in your APIC. So remember how I said, hey, yeah, we got $60 million worth of stock that we printed off, right? So we got the common stock at $1 per share times 1 million shares. There's the million. And another 58? Wait, that only sums up to $59 million. Why? Because, hey, look, we know with $60 million worth of stock certificates, but we had to subtract off the registration fees. So that's where that's where the stock registration fees are going. They're not exactly a debit, they're like a negative credit, if you will. Okay. So down below, I kind of give you an alternative way of viewing this. I say, let's take this same example, but let's break it out into the individual transactions. Okay. We issue stock, we get $60 million cash. Okay. There's the APIC of 59, common stock 1 million. Then let's go ahead and pay off the stock issuance costs with cash. And instead of debiting an expense, let's debit APIC. So right here you can see that, yes, initially there was $59 million credit to APIC, but we reduced it by the stock registration fees. That's the key thing to keep in mind here. There's your 58 million net credit to APIC. Down below, there's the merger expenses, pulling out of cash, and the rest of the journal entry of the merger is down below, and I can break out what's the cash effect. So this is just another way of sort of showing you how to construct this journal entry overall. And I just thought it would be fair to sort of give you different perspectives to make it a little bit easier on you as you're studying. So I want to skip ahead now through a bunch of information in the Learning Objective 3. I think you can read this on your own. I'm not too particularly concerned with it. I want to jump to Learning Objective 4, where we start talking about bargain purchases. These are the distressed situations where we say, ha ha ha, let's get this guy while he's still desperate. No, we're not doing that. There's usually situations where companies, they know that they are faulty, that they're going down, and they say, we've got a couple patents or whatever, would somebody be willing to buy us on the cheap? Okay, some cash is better than no cash. So we come in, we say, hey, look, we're willing to pay $15 million to acquire Miller Lite. Fair value of the assets are as follows. Got some previously unreported intangible assets. This is looking very similar. However, we didn't pay $100 million. Here we're paying $15 million. So if we go down the list here, we plug in, it's just easiest to do it this way in a journal entry. Plug in the tangible assets that we saw on the balance sheet at their fair value. Again, we're always using fair value. Plug in the fair value of the intangible assets that weren't reported. And then again, the plug figure should be apparent. Either you need a debit or you need a credit. If it's a debit, it's goodwill. If it's a credit, it's a gain on bargain purchase. That's what we call it, a gain on bargain purchase, or some type of account called a bargain purchase result. So when you're looking at this, try to keep it simple. If you're comfortable writing the journal entries, you'll be able to figure out what you need to plug in to determine whether you have goodwill or a gain on bargain purchase, or if it's a straight up wash at the end. But the key thing to realize is that when we start to do these journal entries, realize that there's a lot of discussions going on behind the scenes, and a lot of things that we have to consider that we didn't consider before all of a sudden become very relevant because, hey, if we debit something by accident, we have to reverse it out. And the only way to do that is to potentially expense it. That's going to hit our income statement and piss off a lot of shareholders. So that's all I really want to talk about for chapter 2. I think a lot of the stuff you can read on your own. It's pretty straightforward. Some of the stuff we talked about in the previous chapter, and the rest of the stuff, it's new, but you'll see it again in future chapters. So if you have any questions about this, let me know. Otherwise, I'll catch you next time.